Hello friends, today I am going to talk about how to prepare financial statements. So financial statements includes your profit and loss account, balance sheet and cash flow statement. And if you are working in the corporate finance and responsible to prepare financial statement, then this video is going to help you to understand what formats are used in the company and what data are reported in each statements. And if you are new to this channel, I request you to subscribe to this channel. We will start with profit and loss account and then we'll understand balance sheet and then we'll go to cash flow statement. Profit and loss account are generally called as income statement because it provides the details about the income generated by the business. Anyway, I'll explain you more in the upcoming slides. So let's begin. Let's start with a question. Why profit and loss account is prepared? Why a company has to prepare a profit and loss account? What is the need of that, right? So before we understand why it is required, let's understand the complete accounting flow, right? So if I have to understand the accounting flow, I have to start with the journal entries because these are the entries which need to be posted whenever a transaction is occurred, right? And from the journal entries, what we are going to do, recording in the ledgers. So once the journal entry is posted, the same journal entry has to be classified into different ledgers and the amount has to be posted in those ledgers. Then what happens? These ledger balances will be reported under trial balance, right? Trial balance will have all the ledger balances. And from trial balance, we are going to prepare profit and loss account and we are going to prepare balance sheet. Now to know more about profit and loss account, let's understand the ledgers, what is reported in the trial balance. So under trial balance, if you see, we will find ledgers which will explain about expenses and losses. We'll have ledgers which will explain about income and gain. We'll have ledgers which will explain about assets. We'll have ledgers which will explain about liabilities. And we'll have ledgers which will explain about the capital or return earning relating to the shareholders. Now, if you see the first two, the expense and loss and income gain, these two are categorized under profit and loss account. Okay. And what is the purpose of that? To determine the profit or loss of the business for a particular period. Right. So you have income, you have expense. The difference between income and expense is the profit earned by the business. It can have the reverse case as well. So if your expense is higher and your income is lower, then you may end up with loss for that period. Right. Now, coming to the right side, assets, liabilities, and capital, these all will be reported under the balance sheet. And what balance sheet is going to tell you? It is going to tell about the assets and liabilities which are held by the business on a particular day. Now, let's find out the format in which the companies prepare the profit and loss account. So, the format what I'm going to show you now are mostly used by all companies unless certain industry may modify few lines. Okay. So, the format is here. I'll explain you line by line so you understand the complete format. The heading is very clear. The company name XYZ Limited. Then you have to write about the statement for which period, right? So statement of profit and loss for the year ended March 31st, 2025. Okay. And then you can write all amounts are in Indian rupees, or if you are reporting in foreign currency, you can write about the foreign currency if you're preparing for a foreign company. But here I'm giving an example of an Indian company, hence all amounts are in Indian rupees, right? So in this format, you can see in the right side, there are year ended 31st March 2024 and year ended 31st March 2025. So March 2025 means it is about the current year and you are giving a comparative number that is for 2024. Okay. So always there will be a preceding year or you can say previous year number reported along with the current year number, right? This is required as per the Companies Act. Now coming to the items, if you see here, we have income, and under income, you have revenue from operations, other income, and then you have total income, right? And then you have expenses. Under expenses, you have cost of material consumed, purchase of stock in trade, change in inventory of finished goods, WIP, and stock in trade. Then you have employee benefits, depreciation and amortization, other expenses, other gains, finance cost, total expenses. If you see in the note, you have A, B, C, D till J. I am going to explain each and every line item in upcoming slides so you have more clarity about these items. Then you have profit or loss before tax, that is your total income minus total expenses. And once you have profit before tax, and in short, it is called as PBT. From there, you need to deduct current tax and deferred tax expense, or if there is any credit that has to be adjusted, then you derive profit after tax. So let's start with the first one, revenue from operations. So revenue from operations refer to the income generating by a company from its core business activities excluding other source of income. That means if it is a manufacturing company, then whatever they manufacture and sell in the market, that will be revenue from operation. If it is a trading company, then whatever they buy and sell in the market, that will be the main core business activity, right? So what typically it includes sale of products or service, rendering of service, other operating revenue. Now let's see one example. If you're taking an automobile company, what will be reported under revenue from operations? So sales you will have manufacturing goods, it could be trucks, bus, car. Service income is like AMC, extended warranty, any software services given to dealers, right? So those will be all your revenue from operating operations. Now, whether scrap sales will be part of the operating income, the answer is yes, because scrap sales is coming out of the manufacturing, right? When you're doing manufacturing, then certain items will be scrapped, and when you sell that, that also will be considered as other operating income. Few points to keep in note. One is revenue to be reported should be net of expenses as required under IFRS 15 or Ind AS 115. Example, rebates to customers, commission to dealers. So don't forget that. Okay, whatever to be adjusted as per the Ind AS 115, that has to be netted off with the revenue. And the second point is very important, the revenue to be reversed for those sales where the risk and reward has not been transferred to the buyer. It's not that because I have raised an invoice, I'll recognize as revenue. So we have to follow IFRS 15 or Ind AS 115, where we have to check the revenue cutoff. That means whether the goods has been moved out of not or out of the factory, or if it is an export case, whether we have received the bill of lading or not, right? So that need to be checked. Coming to the next point, other income. So other income includes non-operating income, that is interest, dividend, rental income. In the previous slide, we understood what is operating income, mostly the core source of income, right? Now here, apart from the operating income, whatever other income sources the company is having, the same has to be reported under other income. Let's take the example. So whatever income you may have under other income, you could have rental income. That means if the company has subleased certain part of the building, then those will be treated as rental income. Or the company has given plant and machinery to his vendor on rent, for example. In that case, also you will have rental income. Then the company may have commission, right? So if there is any contract and the company has to earn commission on that, then that commission income has to be reported here. Unwinding of discount on security deposit. So this is mostly related to the fair valuation of the security deposit, right? So when you are doing the fair valuation, if any portion of security deposit has to be increased during the year, then that will be treated as an income and that will be reported here. Interest on income tax refund, income from job work, right? If the company is doing any job work, that means the customer is giving material and you are putting your labor and you are doing the activity, then for that job work, you have to raise invoice and recognize the revenue under other income. Interest on bank deposits, dividend on investments, miscellaneous income, all this will be reported under other income. Few points to keep in mind. Ensure that income is accrued for the cases where invoice has not been raised. So when you are preparing your financials, if the invoice is not raised, ensure that you accrue the income for that period, right? Interest income to be accrued for the amount not credited in the bank account. We should not go on cash basis because interest is on time basis. So if you have received the interest income in the month of February, for example, and the next installment you may get from the bank after 1 quarter. But when you're preparing the financial statement as on 31st March, for the month of March, you have to accrue the interest income. Similarly, dividend has to be accrued if the shares were held on X dividend date. Because on if the company is holding the shares on X dividend date, which is declared by the company, then you are eligible for the dividend. Hence, you have to accrue the dividend. So you have to take care of that before reporting the numbers under other income. To the next point, that is cost of metal consumed. So cost of metal consumed has to be reported by manufacturing companies. This is not applicable for service industry, right? Because in service industry there is no question of raw material or WIP or finished goods. So this is only applicable if you are doing manufacturing company's financial statement. Now, cost of metal consumed means the amount of raw material consumed during the reporting period. The consumed raw material would have been sold during the reporting period or the company is holding it as finished goods, right? So the consumption may end with sale of goods, or the consumption would have been stored as inventory on the date of reporting. Now let's take the example how it is reported. So raw material purchased during the year you have to report, and you have to add the opening stock. That means if you are preparing for the period April to March, right? So whatever opening stock you had on 1st April, you have to add that less closing stock. That is what is the inventory you have as on 31st March, and then the derived number is the cost of metal consumed, right? Because opening plus purchase minus closing, the net amount is cost of metal consumed. Now, what you need to keep in mind, raw metal purchased during the year, what you are going to report should match with the purchase register. So purchase register the company will be maintaining, or it could be in the ERP system. If you are having SAP or any other accounting system, you can download the purchase register. The value what is reported in the purchase register should match here. But yes, in certain ERP, like freight cost or custom duty paid are not captured. So in those cases, you need to do a manual calculation to derive that number and report it here. Second point, opening stock and closing stock of raw material has to be valued as per the company policy. So if the company is following FIFO weighted average method, then you have to revalue the opening stock and closing stock at that rate, and then you have to apply this formula. Why I'm talking about this? Because certain companies they follow standard costing. So in that case, you can't apply standard costing. You have to convert the standard costing to the company policy requirement like FIFO weighted average or moving average, and then that number has to be applied here in this formula. Coming to the next point, purchase of stock in trade. So purchase of stock in trade has to be reported by trading companies and manufacturing companies if they are involved in trading certain products, right? So let's take an example how it looks in case of automobile company. So automobile company may report purchase of engines. If they're purchasing engines and selling to the dealers, then it has to be reported here. Purchase of spare parts. This is one of the major business for the automobile company, right? But instead of they manufacturing the spare parts, they will get it from their vendors and then they will sell it to the dealers. So the way it has to be reported is all purchases during the year has to be clubbed and reported under purchase of stock in trade. Now, this purchase, what you're going to report here, you have to ensure that it matches with the purchase register. This is very critical. If you're not matching, then your auditor may come and challenge you saying that the numbers reported in the financial statement is not correct. So whenever you're reporting these numbers, ensure that the numbers matches with the purchase register. Next point is changes in inventories of work in progress, stock in trade, and finished goods. Quite interesting, right? The previous one we talked about raw metal consumed, and then we talked about stock in trade purchase. Now we are talking about changes in inventory of work in progress, stock in trade, and finished goods. Let's understand further. Raw metal consumed and stock purchased during the year are not the cost consumed by the business, as there may be instances where raw metal consumed or stock purchased during the period are part of closing inventory and not sold to the customer, right? Because in P&L we need to check, or we need to report is what is cost of goods sold, right? Not the complete purchase what you have done during the year. So we need to determine the cost of goods sold, hence change in inventory is calculated. That's the reason we need to report change in inventory. Now how the change of inventory is reported? If you see change in inventory of WIP, stock in trade, and finished goods, you will have the opening stock. That means whatever stock you reported as closing stock for March 2024, and it is carried forward to 1st April 2024 as opening stock, all that you have to report it first. That is work in progress, finished goods, stock in trade. Now you have to reduce the closing stock what you are reporting on March 2025. That is on the date of preparing the financial statement. So work in progress, finished goods, stock in trade. The difference between opening and closing stock will be reported as change in inventories, right? Now what is happening? The cost of goods sold what you are taking to the profit and loss account has three category, right? Raw material consumed what we reported, purchase of stock in trade what we reported, and changes in inventories. All together will be the cost of goods sold, right? But this is the format used in the Companies Act. Instead of directly writing cost of goods sold, we have to report into three category, but the sum of all these three will be reported as cost of goods sold. This will give more clarity about your raw material movement, your stock in trade movement, and the movement of the stocks as well. Hence the cost of goods sold is reported in three different line items. After material, the most important cost which the company spend is on employee benefits, right? So all the cost incurred towards the employees of the organization has to be reported. This also includes the cost incurred towards the retirement benefits of the employees. So how it is reported? You can see the template here. Salaries, wages, bonus, including leave encashment, employer's contribution to PF fund, provident fund, and other funds, gratuity expenses, staff welfare expenses. Right? Now, few things you have to keep in mind. Salary to be reported is for both white collar employees and blue collar employees, right? The factory workers. Don't think that the blue collars will be reported somewhere else. It will be part of this employee benefits. Consultant cost will not be reported as salary because consultant is not the employees of the company. So that has to be removed from here. If you are adding it here, you can't report it. Third point is very important that actual valuation is required for all retail benefits like gratuity, leave encashment, retention bonus if you're paying after 1 year, right? Cost reported in these valuation reports should be reported under employee benefits. It has to match. Your statutory auditor will ensure that the numbers reported in the actuary valuation report tallies to the amount what you're reporting under employee benefits. And in that valuation report, if you find that certain amount has to go to other comprehensive income, then that amount has to go to OCI. You can't report under employee benefits. After reporting employee benefits, you need to report about depreciation and amortization. So depreciation and amortization on tangible and intangibles assets to be reported. This amount has to be mapped from fixed asset schedule, right? So when you prepare the balance sheet, you will have a fixed asset schedule. So the depreciation what is reported in the fixed asset schedule should be mapped here so that there is no difference between the fixed asset schedule and the depreciation you're reporting in the profit and loss account. After that, you will have remaining all other expenses. So whatever is not captured in your material cost, salary cost, depreciation, remaining all will be shown under other expenses. So let's take an example what is reported under other expenses. Consumption of indirect items, right? So in the factory, if you have consumables or small indirect items, then the consumption whatever has happened during the year has to be reported here. Power and fuel, which may includes like electricity or any other power you are using, solar for example, right? Then rent, any rent you have paid during the year has to be reported here. Repair and maintenance for building plant and machinery, always you have to keep in mind that you have to show separate amount for building and separate amount for the plant and machinery. Then next is insurance, right? Any insurance you have paid, it could be your employee insurance, it could be insurance relating to your transport, right? All has to be reported here. Rates and taxes, so all type of any taxes and rates which you have paid, okay, you have to report it here. Legal and professional fees, so any type of consultancy or any type of professional services you have received from anyone, if you have paid to them, then that has to be reported under legal and professional fees. Payment to auditors, mostly your statutory auditors, whatever fee you have agreed as per the board of directors agreement, the same has to be reported here. Then software charges, traveling and conveyance, mostly your employee travel. Royalty, if you're paying royalty to your parent company or to a third party from whom you have taken the technology, then that has to be reported here. Advertisement and sales promotion expenses. Warranty claims, whatever warranty claims you have received, only you have to keep in mind that any warranty claim which has not been settled has to be provisioned. That means you have to take provision for that, okay, not that only whatever you settle only you have to take it here. Freight charges, loss on sale of assets, provision for doubtful debts, or if there is a bad debt also you have to report it here. Then you have CSR, corporate social responsibility, as per the law 2% of your average 3 years profit you have to spend on CSR, so that amount you have to report it here. And then miscellaneous, okay, you have to keep in mind that any amount which is major or generally as per the companies act it is 1% of the revenue. If that expense is of higher value, then you have to report as a separate line item here. Okay. Next one is other gains and losses. So any type of gains or loss on revaluation of financial assets has to be reported here. Example, fair value loss or gain on derivatives not designated as hedges, right? In that case, like for example, MTM, mark to market, those valuations, if there is a gain or loss, has to be reported here. Similarly, your forex restatement or exchange loss and gain, you name it in any way, has to be reported here. Okay, so this will be reported under other gain and losses. Next one is finance cost, right? So all finance cost like borrowing cost, loan processing cost, lease cost has to be reported here. So the format is here: interest on borrowing, finance cost on lease. So if you're following Ind AS 116, in that the finance cost of lease whatever you pay to your landlord, okay, that will be derived here and it will be reported here. And other interest may include like your interest on MSME vendors, right? You may accrue as per the MSME Act. So all these interest costs will be reported under the finance cost. Next item is tax cost. So current tax has to be derived based on the Income Tax Act requirement, right? Similarly, deferred tax movement has to be derived based on movement of temporary difference. Because of the temporary difference, you will have either a deferred tax asset or a deferred tax liability. So here is a sample. Here is a sample. Deferred tax assets arising from, right? You are giving the temporary difference here. For example, defined benefit obligations, provisions, RU assets, other items. So these are few examples of temporary difference. Less deferred tax liabilities arising from plant property equipment. For example, the WDV of the books and the WDV as per the Income Tax Act may be different. Financial assets, right? So this is the format generally used, but yes, line items can vary from business to business based on the temporary difference what you have. Then the deferred tax asset of last year versus the deferred tax of asset of current year, the movement will be either a deferred tax income or a deferred tax expenses, right? Because if it is increasing, then it is increasing deferred tax asset. If it is decreasing, then it is a deferred tax expense, right? So this is how you'll be accounting it in the profit and loss account. Now let's understand how a balance sheet is prepared, what are the formats used, what are the items reported. So let's begin. Now let's check in what format the balance sheet is prepared. So what I'm going to do now is that I'll be showing the format only for the assets now. Then I'll talk about asset items which need to be reported. And then I'll show you the format for liabilities and the liabilities items which need to be reported. So this is how the format is going to look. Okay. You start with the company name at the heading, for example, XYZ Limited. Then you write balance sheet. All amounts are in Indian rupees unless otherwise stated. Okay. And then you can see there are two columns here as at 31st March 2025 and then as at 31st March 2024. You have to always give your preceding year or you can say previous year number as comparative numbers, right? Now, coming to the left side where we have assets, you can see there are two categories, non-current assets and current assets. So to give more clarity about non-current and current, non-current are long-term assets, okay? Or you can say assets where the company has no intention to get the asset converted to cash in future. Future means in within 12 months, okay? Or where you are going to get money from your customers or from any other person after 12 months. Okay, we'll have more clarity when I'll explain you different terms. But now you can see non-current, under non-current you have property, plant and equipment, capital work in progress, right of use assets, financial assets, deferred tax asset, and other non-current assets. Okay. Once you report non-current assets, then the second category is current assets. Under current assets, you have inventory, financial assets like trade receivables, cash and cash equivalent, other financial assets, and other current assets. And generally, current assets are more like liquid in nature. That means you are converting these assets very quickly. That means within 12 months time. Hence, it is categorized as current assets. And the total, your total non-current asset and current asset total is reported as total assets. So let's start with the first one, that is property, plant and equipment. Both tangible and intangible assets are reported. Gross block, accumulated depreciation. Depreciation for the year is reported. And below is the format which is generally used by the companies. So if you see in the format, you have asset categories, right? It could be tangible assets, it could be intangible assets. If the company is not having any intangible, then no need of reporting that. And then you have gross block, then you have accumulated depreciation and the net value. Okay. So I'll show you one example so you understand how it is reported. Let's take the example of land. Okay. In gross block, you have to give the moment, that is the opening balance, additions, deletions, and the closing balance. Okay. Similarly, in accumulated depreciation also, you have opening balance, additions. Addition means the depreciation posted during the year, then deletion and balance as on 31st March 2025. And what is net value? Net value is your closing gross block minus the closing accumulated depreciation, which is generally called as written down value, right? So one example I can show you here, like land, you had opening balance of 10,000. There is no addition of land during the year. Hence the closing balance is 10,000. There is no depreciation because there is no depreciation on land, right? Hence the net WDV is 10,000 rupees. Coming to building, You have opening balance 20,000, addition 4,000, no deletion. Hence the closing balance is 24,000. That is on the gross block side. On accumulated depreciation, you had 3,000 opening. Addition during the year is 2,500. Deletion nil, and your balance as on 31st March is 5,500. And what is the net WDV? Net WDV is gross block was 24,000 minus your accumulated depreciation closing is 5,500 and net is 18,500. So this is how the format is used, and it is not limited that this particular format will be used by all companies. So if you have different asset categories, you can list down that as per the Companies Act requirement and prepare this format. One thing you have to keep in mind that the depreciation has to be as per the Companies Act. You can't have a different depreciation rate unless management explains why you are having a higher depreciation rate compared to the Companies Act. But this is the format what is generally used by all companies. Next item which need to be reported is capital work in progress. So what is capital work in progress? Capital work in progress are the assets which are not yet ready to use as on the date of preparing the balance sheet. For example, like building construction, installation of huge machineries, right? Because these activities are not completed, you can't capitalize nor you can charge depreciation. Okay, so these all assets are in progress. So what is the template or format you need to report? You can see this standard template as per the Companies Act requirement. You have to prepare and report. You will have in the left side projects in progress, okay, and projects temporarily suspended, and then you are giving the aging of the work in progress. So less than 1 year, 1 to 2 years, 2 to 3 years, more than 3 years, and the total. Okay, so if you see here as an example I've given project in progress 10,000, 30,000, 20,000, 3,000, and the total is 65,000 rupees. Now projects temporarily suspended like 1 to 2 years, I've given a number here 15,000 rupees. Here your auditor may challenge you that why this is temporarily suspended. Are you going to restart again? If not, then the auditor may ask you to write off this because you are not going to use this asset, right? It may be because of some technology change, because of any other reason, the project is on hold and nothing is moving forward. Unless the business comes with a specific reason why there is any temporary hold, unless it is clarified to the auditor will ask you to charge it off. So this is the format which will be used for CWIP. Next item which need to be reported is RU assets, right of use assets. So RU assets refer to assets that are used by the company but not owned by them. Okay. So RU assets are recognized on balance sheet when a company enters into a lease agreement, giving them the right to use an asset. Example like property, equipment, or vehicles for a specific period. Right. I'm not going to talk how this valuation is done. That will be mostly covered under your Ind AS 116. But I'm going to talk about the presentation in the financial statement, how it will be presented in the financial statement. So here, if you see, this is the format to be used. You will have different categories like building, car, plant and machinery, or if any different category of lease you have, you can put there. And then the format is movement from opening to closing. So opening balance as on 1st April 2024, you will have the values. Addition during the year, that means if you have taken any new lease during the year, then that has to be reported as addition here. Less amortization, the depreciation will be for the period of lease. So you have to depreciate that. And then the closing balance. So opening plus addition less amortization is the closing balance. And this number has to be reported in the balance sheet. Next point which need to be reported is financial assets, non-current. Non-current means which you are not going to receive in next 12 months time, right? So here few examples are there like security deposit. If you're given a security deposit where the maturity is after 12 months, then that need to be reported here. But yes, you need to do the fair valuation as well, right? So you have to take out the present value of this security deposit, and the difference between the actual payout and the fair value has to be charged out to rent. Then you may have like derivative financial assets. Those also, if it is going to be matured after 12 months, then you have to show it as financial asset non-current. Next item which need to be reported is deferred tax assets. So a deferred tax asset is an item on the balance sheet that results from an overpayment or advance payment of taxes because of temporary difference between accounting and tax books, right? So because of certain items allowed, not allowed under tax books, that item is transferred to next years or future years, right? And you will be getting the tax benefit in those years in which year you are going to claim that. And it is opposite of the deferred tax liability which represents income tax owed. So This is a template, not that all this item what is there in the template will be applicable for every company, but it is a standard template to give a clarity that how the deferred tax asset or liability is calculated. So you can see there are 2 years here, current year and previous year, and deferred tax asset arising from, that means the temporary difference you are writing down here, defined benefit obligation, for example, for employees, provisions, RU assets, other items, less deferred tax liabilities arising from plant property equipment financial assets. The difference between assets and liability is reported as deferred tax asset. That means if the deferred tax item are higher than deferred tax liability, then the difference between both will be shown as deferred tax asset. However, if it is a reverse situation, that means your deferred tax liability is more than your deferred tax asset, then instead of reporting as deferred tax asset, you have to report as deferred tax liability. That means in future, you are going to pay more tax because of the temporary difference adjustment during, because of adjustment in the during the year. Next item which need to be reported is other non-current assets. Okay. And what are the examples here? You have advance income tax, which will be reported net of provisions, right? So the tax what you pay to the government authorities has to be reported here. Then prepaid expenses, any prepaid expense which you are going to amortize to expenses after 12 months, that portion will be reported here. Similarly, capital advance, long-term capital advance, balance with government authorities. That means you have tax credits with the government, but the utilization will happen only after 12 months. Okay. So if that situation is there, you have to report it here. And then other deposits, it could be your electricity deposit or any other deposit where you are not going to recover the money in next 12 months time, has to be reported as other non-current assets. Next one is inventories. This is very important in case of manufacturing unit. The term inventory refers to raw material used in the production as well as goods produced that are available for sale, right? So how the template or how it looks, the format looks, raw material and components will be reported, work in progress will be reported, finished goods and stock in trade, right? Stock in trade is generally used in case of trading business, but as if a manufacturer is doing trading as well, then the format will include manufacturing stocks as well as the stock in trade stocks. One thing you have to keep in mind that the stocks has to be valued as per the company's policy. That means if the company is following FIFO or weighted average, then you have to revalue these inventories and report it under those methods. Okay, because certain companies they follow standard costing. Standard costing is not allowed as per the accounting standard. Hence, you have to rework or revalue your inventory to weighted average or FIFO, and the difference of that you can charge to cost of goods sold. Next item to be reported is trade receivables. So amount receivable from customer for sales of goods or services is reported as trade receivable. So under trade receivable, there will be two categories. One is trade receivable from other parties and receivable from related parties. So these two categories has to be reported under trade receivables. However, if there is any doubt on collection from any customer, that means we feel that after a lot of dunning process, the amount is not coming to the company, then the company can take a provision for the doubtful debts. And that provision has to be netted off under trade receivables. That means the amount what you're going to report under trade receivables should be the net amount after adjusting the provision for doubtful debt. One point you have to keep in mind that under this format, you have to report the trade receivable aging as well to give more clarity to the shareholders that what is the aging of your trade receivables? Are there something old trade receivable for which you have not created provisions? So all that clarity will come only when you prepare the trade receivable aging. The next one is cash and cash equivalent. Under cash and cash equivalent, it's mostly the liquid cash you have to report for the company. So the format you can see here, you will have to report fixed deposits, balances in banks, right? Your current account or EEFC account if you are holding any foreign currency cash balance. Next item to be reported is other financial assets. So you can see the format here. It is security deposits, right? Unbilled revenue. That means if anything you have missed out to bill it, and you have not invoiced it, then you are accruing that revenue, right? So that will be reported here. And unbilled revenue related party. So if something is not billed to your related party, that also has to be reported here. And all this will be under other financial assets. Next one is other current assets. So any other current assets has to be reported. Okay, this list what I'm showing here is few examples, but as a company you can have more items in that. So for example, like prepaid expenses, advance to employees, advance to suppliers, balance with government authorities. So all these are current. And why it is treated current? Because the company believes that these amounts can be converted to cash or can be utilized in next 12 months. Okay, whatever is beyond 12 months, that is already reported under non-current. Whatever within 12 months is reported under other current assets. Now let's understand what is the format used to report equity and liabilities. So the format looks same, only the items I have to explain you. You have equity, equity share capital, reserve and surpluses. This together will be total equity. Then you have liabilities. Under liabilities, again, similar to assets, you will have here non-current liabilities and current liabilities. Non-current are long-term, where you are going to discharge this liability only after 12 months. Current will be which you are going to discharge in next 12 months time, right? So under non-current liabilities, you will have financial liabilities. Under that, you will have borrowings, lease liabilities. Then you will have employee benefit obligations, right? Under current liabilities, you will have financial liabilities again, borrowing, lease liabilities, trade payables, other financial liabilities, employee benefit obligation, and other current liabilities. So I'll explain you each and every line item in upcoming slides. The first item which need to be reported is equity share capital. So under this, you have to report about your authorized capital, okay, which is approved by the Ministry of Corporate Affairs. So for example, here you have 1 lakh equity shares of 10 each. So 10 lakh rupees will be reported authorized capital. Below that, you have to show out of authorized capital, how much has been issued, subscribed and paid off capital. So for example, here out of 1 lakh equity shares, the company has only issued 60,000 equity shares. So that has to be reported here. 60,000 equity shares at the rate of 10 each is 6 lakh rupees. Now, reserve and surplus. Under reserve and surplus, you will have different type of reserves here, like capital reserve, general reserve, okay, and then surplus in the statement of profit and loss. So when you prepare the profit and loss account, you will have a profit or loss that has to be transferred to the equity fund, right, under reserve and surpluses. So here is the table what you are showing to the shareholders. That balance at the beginning of the year, add profit or loss for the year adjustment, then if there is any other comprehensive income, that has to be adjusted, okay, and the net will be the net reserve and surplus which is available to the shareholders. Next item to be reported is borrowings. So company can have different type of borrowing, you can list down here. So as an example, I've shown here term loan from banks, you have to report it here. Is there any ECB loan? If yes, then you have to report external commercial borrowing also. In term loan, you have to keep in mind that if there is an interest which is due and you have failed to make payment, okay, that has to be added here. Okay, so keep in mind that if any interest which is not paid, then you have to add it and report it under term loans from bank. The next one is lease liability. This is similar to the RU assets what I explained. Under lease liability, again, this is the format which will be used. You will have opening balance again for different category of lease what the company has taken. With opening balance, you have to add new additions. That means if there is a new lease during the year, you have to report that. Finance cost accrued during the period. So because you are doing a fair valuation, right? Present value, the finance cost will be added here. And then payment made to landlord. Correct. So whatever payment you've done during the year to your landlord, the same has to be reduced here. Or to the company from whom you have taken the lease, the same has to be reduced from here. Then you will have the closing balance. One thing you have to keep in mind that this lease liability has to be classified into non-current and current. That means any lease liability, whatever you are going to pay after 12 months, that has to be classified as non-current, and what you are going to pay in next 12 months from the date of reporting, that has to be reported as current liabilities. Coming to the next item, other financial liabilities. So under other financial liabilities, you will have like capital creditors, interest accrued and not due on borrowings, payable to dealers, retention money, right? These are all other financial liabilities. And then the last one is other current liabilities. So again here, like advance to customers, unearned revenue. That means, you have billed it excess compared to what actually you should bill. So you have earned the revenue more than the requirement. So this is unearned revenue is equal to a liability, right? Because in future years you are going to adjust that. Employee benefits payable, statutory liabilities. So these all will be reported under other current liabilities. The last statement, which is very important for the shareholders, that is cash flow statement. It gives the complete picture of the company on the cash flow side. That means inflow, outflow of the cash, right? So let's understand how it is reported and how the shareholders understand the cash flow statement from different activities. That is what I'm going to explain in upcoming slides. Before we understand cash flow statement, we need to have understanding on few terms. The first one is cash. Cash includes cash in hand, checks in hand or deposited not encashed, cash at bank, and demand deposits with bank. Now let's understand what is demand deposit. Deposits which can be withdrawn without prior notice and penalty charges. Long-term deposits are not demand deposits as they are placed for a specific period in banks, and these cannot be withdrawn without penalty. Cash equivalent. An asset can be called as cash equivalent when it satisfies the following conditions. A. Short-term and highly liquid investments which are readily convertible into cash, and conversion into cash is subject to insignificant risk of changes in value. Okay. So what is the meaning of that? Any asset which can be converted immediately, and when you convert, the value doesn't change. The risk is very limited. Short-term investment is an investment which has a maturity of less or equal to 3 months from the date of acquisition. So date of acquisition is the main point which you have to keep in mind, and the maturity is 3 months. Example, treasury bills, government securities having maturity within 3 months from the date of acquisition. Similarly, preference shares acquired only when the entity acquires 3 months before their specified redemption date. So these all will be treated as cash equivalent. And you need to understand that bank overdraft, which are payable on demand, will be included as part of cash equivalent. So these are the definition about cash and cash equivalent. Now let's try to understand the meaning of cash and cash equivalent by an example. Company has provided the following details regarding the various assets held by company on 31st March 2023. Find out which of the following items will be part of cash and cash equivalent for the purpose of preparation of cash flow statement. So let's see the example. You have fixed deposit with State Bank of India. Additional information is 12%, 3 years maturity on 1st January 2026. Second one is fixed deposit with the SDFC. Additional information is 10%. Original term was for 2 years but due for maturity on 30th June 2023. Redeemable preference shares in ABC Limited acquired on 31st January 2023 and the redemption is due on 30th April 2023. Cash balance at various banks, which is in all branches in India. Cash balances at various banks, branches of foreign banks outside India. And the last one is bank overdraft of SBI branch, temporary overdraft, which is payable on demand. Now let's try to understand in each case which will be categorized as cash equivalent or cash. So in the first one, it is not considered as it is long term because the maturity period is 3 years. So as we explained in the previous slide, from the date of acquisition, it should be 3 months. The maturity should be 3 months. So in this case, the maturity is 3 years, hence it is long term and will not be classified as cash equivalent. In case of second one, SDFC deposit, here also the maturity is not less than 90 days. It is 2 years, hence it will not be considered. In case of redeemable preference shares, this will be included because it is acquired on 31st January and from that date within 90 days it is redeemable. As it is redeemed or will be redeemed by 30th April, which is 90 days, it will be treated as cash equivalent. Coming to cash balances, whether it is in India or outside India, it will be included. And bank overdraft, if it is payable on demand, then the same will be included as part of cash equivalent. Let's try to understand how the cash flow statement is prepared. As per Ind AS 7, cash activities of an entity has been classified into three. So there are three types of cash activities which we will explain in details. Such classification should be most appropriate to its business. This classification is based on the nature of business of the entity. Okay. So let's see what are the different type of cash activity. The first one is financing activities. Second one, investing activities. And the third one is operating activities. So all these three different activities will give different information to the user. And in subsequent slides, we'll understand how each activity is giving a different picture or a different analysis to the user. Financing activities. Let's try to understand what are the activities which will be included under financing activities. The activities which changes the size and composition of contributed equity. That means if the company issuing right shares or getting more capital, or there is any change in the structure of the capital or preferred shares, all will be captured here. Second is borrowings and repayment of borrowings. So mostly if you see on the financing activities, generally to run the business, if the company is getting fund from outside, whether through equity or through borrowing, all those will be recorded in the financial activities. And the third one is financing costs on equity, preference and borrowings and other kind of finances. So all type of finance cost incurred to get this borrowings or equity has to be recorded here. Let's see a few examples what are covered under financing activities. A, issue of equity and preference share capital. So when you issue, you get the money, so it's a cash inflow. Buyback of equity shares. In case of buyback, the company pays to the shareholders, so it is cash outflow. Redemption of preference shares, same, cash outflow. Borrowing loans and issue of debentures. So you take loans, so there is a cash inflow for the company. Repayment of loans and redemption of debentures. So when you settle the loan, it is cash outflow. Now, point number F, if you see, it is interest payment, preference dividend payment, equity dividend payment. These are all financial cost. This is the additional cost you pay to the shareholders or to the bank. And the last one is cash payment by a lessee for the reduction of outstanding liability related to lease. So under Ind AS 116, if there is any payment of rent to the lessor, that has to be captured here as payment towards financial activities. Investing activities. Let's check what are the activities included under investing activities. The first one is purchase and sale of long-term assets and other investments which are not cash equivalent, and income received from investments. So majorly investing activities take care of the amount what the company has invested in fixed assets or other long-term assets which are not treated as cash equivalent. Let's take few examples. Acquisition and disposal of fixed assets, including intangible. So in case of acquisition, there is cash flow out. That means the money will go out. Whereas in case of disposal of fixed asset, there is cash inflow. Acquisition and disposal of shares, debt securities of other entities. So if you have invested in other entities, then that is cash outflow. And when you sell those investments, it is cash inflow. Loans and advances given to third parties. And the last one is interest, dividend, and rental income receipts. All these are treated as income from investment. Operating activities. So let's try to understand what is included under operating activities. Principal revenue producing activities. That means whatever the company does transaction to generate revenue will be part of operating activities. Activities which cannot be classified as investing or financing activities. It means residuary activities are also operating activities. So whatever activities can't be treated as investing or financing activities will fall under operating activities. We have few examples, we'll look into it. Let's take few examples.
Cash received from sale of goods or services. So it is cash inflow because you are selling and getting money from the customer. Payments made to suppliers for goods or services. Cash outflow, you're making payment to the supplier. Receipts of royalties, fees, commission, and other revenue. Again, it is a cash inflow. You're getting this money from customers. Payment to employees, it is cash outflow. Insurance premium payment, again, and cash outflow. Cash theft, here, nor you are paying nor you are receiving. But anyway, there is a reduction of cash. And this can't be classified under investing or financial activity. Hence, it is a residuary item which is classified under operating activities. Similarly, cash received from insurance claim on fire accident is a residuary item because it is not part of financing or investing, nor part of core operation activity, but will be treated here because it is a residuary activity. And operating activities are very important because the shareholders generally look into operating cash flows to check whether the company is able to generate cash from operations or not. Cash flow statement. So this is how the cash flow statement is prepared, where all different type of cash flow activities are reported, like cash flow from operating activities, cash flow from investing activities, cash flow from financing activities. All three together will show the net cash flow, and then we need to add the opening cash and cash equivalent. The total will be closing cash and cash equivalent. And here we need to keep in mind that the closing cash and cash equivalent should tally to the amount outstanding with all this cash and cash equivalent on the given date. Cash flow from operating activities. In case of financing activity and investing activity, determining the cash flow is easier. It is based on the transaction. Either you have a cash inflow or cash outflow. However, for operating activities, there are two methods which I'll be explaining in upcoming slides: direct method and indirect method. So let's start with an example. Mr. Ram invested rupees 1 lakh in a business. During the current year, the business has following activities. All raw material purchased has been sold during the year. So this is the assumption. So these are the transactions what Mr. Ram did. Purchase of raw material, cash 20,000, credit 10,000. Sale of finished goods, cash 30,000, credit 40,000. Salary paid to employees, cash 10,000, no credit. Bonus payable, which is not paid to the employee, hence it is outstanding as payable, credit. Okay. Considering this transaction, if we prepare the profit and loss account, we'll have expenses like raw material 30,000. Even though it is cash and credit, on accrual basis, both amount has to be reported under profit and loss account. So 30,000 is the cost. Similarly, salary 10,000 and bonus, even though it is not paid on accrual concept, it has to be accounted, hence 5,000. On the other side, income is 70,000, even though 30,000 received in cash, on accrual basis, both 30 plus 40 has to be reported, so 70,000 revenue. And the company earns net profit of 25,000 rupees. On the balance sheet side, you can see that there is a capital of 1 lakh rupees which he invested in the business. Payable raw material 10,000 which was purchased on credit. Payable bonus 5,000 which was not paid to the employee. Profit and loss of 25,000 rupees which was earned during the period is part of the capital here now, or in the liability side. And on the asset side, if you see, we have a receivable of 40,000 rupees from the customer, and cash in hand has changed. 1 lakh minus 20,000 which is paid in cash raw material, 10,000 salary paid, plus 30,000 what the business has received by selling goods. So if you see in both sides, the total is 1 lakh 40 and 1 lakh 40. This is the balance sheet what we have. Now considering the direct approach, let's see how to prepare the cash flow statement from operating activities. So gross receipts from operating activities, sales rupees 30,000, less payment for operating activities, raw material purchase 20,000, salary paid 10,000. So cash flow from operating activities nil. What you received is what is paid out. Okay, so gross received minus payments made is the cash flow from operating activities. Now again, we are going to calculate the cash flow from operating activities, but by using the indirect method. Under the indirect method, the calculation always starts from the profit earned during the period. And from there, we need to do the adjustment of movement of operating assets and movement of operating liabilities. So let's check out how it is calculated. So profit here is 25,000 rupees. Change in operating assets and liabilities. Increase in assets will always be deducted because in increase of assets, you don't get the money inflow. Hence, it is shown as negative. Similarly, increase in trade payables will be shown as a positive inflow because you're not paying, correct? Indirectly, it is a cash inflow for you. So here, if you see increase in trade receivable is 40,000 rupees, which is negative because in the opening period, it was 0. From there, it increased to 40. We are always comparing with the previous period. Similarly, the trade payable of 15,000, 10,000 raw material payable and bonus payable of 5,000 rupees is shown here as additions. Cash flow from operating expenses is nil. So in both the method, the result will be same. However, in indirect method, it is quite easier to calculate because you will have the opening balance sheet and the closing balance sheet, which can be compared easily. Note here, any financing activities, investing activities or non-cash item included in profit and loss account has to be removed from the profit and loss and to be adjusted in respective cash flows from financing and investing activities. For example, if the company has received dividend, which is reported as part of profit and loss account, that has to be removed here from the profit and the same has to be shown as cash inflow from investing activities. So that adjustment need to be done. In this example, because we don't have any item which is investing or financing activity, hence that has not been adjusted from profit. One more point you need to keep in mind that in case of tax payments, that has to be adjusted with operating activities unless the tax is very clearly identifiable for any different activities. For example, if there is a capital gain tax paid on sale of fixed assets, then that capital gain tax has to be reported under investing activities, not under operating activities. It is quite challenging to separate it, but yes, if the business or the entity is able to identify what is the amount paid for that particular activity, then the tax amount also can be segregated. So this is all about the cash flow. Let me know in the comment section if you have any specific doubt. I'll be happy to clarify that. Thank you.